In this video, we will discuss the 5 best tips to retire early or as soon as possible, and we will go over some bonus tactics that I use to make money fast. For more educational finance videos, press the like button and subscribe. With that said, let's get right into the video. Navigating the complex terrain of retirement planning can be an intimidating endeavor for many individuals. The financial landscape is replete with an array of retirement plans and investment firms vying for attention, but we will be skipping right to the most pressing information that you need to know. Despite formidable obstacles, I believe you can use the following established principles to chart a course toward a retirement that is fortified with fiscal stability. These time-tested principles will put you one step closer to attaining your retirement aspirations. Here, we delve into a selection of these retirement rules of thumb that serve as stepping stones toward a future imbued with financial assurance and prosperity. Step number 1. Start saving and investing right now. The adage of an ancient Chinese proverb says that the best time to plant a tree was 20 years ago. The second best time is now. This axiom holds particularly true in the context of investing, especially in regard to retirement. In an ideal world, you should already be saving, but life, however, often intercedes, entangling us in short-term financial demands like car payments, social outings, and educational expenses. Yet regardless of past inaction, it's never too late to start or enhance your journey to financial freedom. Regardless of your age, you need to start investing and saving for retirement. Plant the seeds now and witness the growth facilitated by the alchemy of compound interest. Step number 2. Aspire to invest 15% of your earnings. The Employee Benefit Research Institute's 2023 survey on retirement confidence has registered a dip in American workers' confidence regarding the adequacy of their retirement funds, plummeting from 73% in 2022 down to just 64%. Should you confront the need to recalibrate your retirement saving strategy due to impediments such as debt or escalating expenses, the 15% savings guideline should be looked at as the minimum starting point. This rule advises that you should put 15% of your earnings, not including any extra contributions from your employer, straight into your retirement portfolio. This percentage allocation of 15% is tailored to individuals in their 20s and 30s, so this guideline can serve as a robust foundation. However, should your journey commence later in life, a recalibration of this percentage will need to be increased to align with your retirement objectives. It's paramount to recognize that the optimal savings quotient is contingent on multiple variables such as your encompassing life expectancy, prevailing spending and saving proclivities, and the lifestyle you envision during retirement. One of the best tools to use in this step would be a retirement calculator to delineate an appropriate savings percentage tailored to your particular circumstances. By inputting your monthly expenditures, saving contributions, and income, this finance tool will offer insights into the trajectory toward achieving your savings aspirations. Step number 3. Try to avoid investment expenses and banking fees. The amplitude of your retirement portfolio is profoundly molded by the expenses associated with your investments. These costs typically arise from expense ratios tied to mutual funds and exchange-traded funds, in conjunction with fees linked to buying and selling stock. The expense ratio is a yearly percentage fee that represents a continual levy for holding a fund. To illustrate, an investment of $10,000 in a fund boasting a 1% expense ratio would translate to an annual fee of $100. This expense can be readily discerned through investment research platforms such as Morningstar or the websites of whichever company is offering the fund. As a guiding principle, when choosing investments, try to invest in a fund or ETF that has an expense ratio that is as close to 0% as possible. Nevertheless, a concession of up to 1% might be reasonable for specific fund categories like international or small-cap funds. To mitigate transaction costs, you're presented with 2 straightforward strategies. You can buy single blue-chip stocks like Microsoft, and you can embrace a buy-and-hold strategy. Another great investment to buy and hold would be ticker symbol VOO, which tracks the top 500 companies on the U.S. stock market. In tandem with investment fees, pernicious banking fees are indispensable, given their potential to erode retirement accumulations over time, so avoid these by buying low-expense ratio investments like VTI and SCHD. Other ways to safeguard your portfolio against these levies involve opting for fee-free or low-cost accounts, maintaining the stipulated minimum balance, and minimizing transactions within the account. Step number 4. Abstain from enigmatic investments. Essentially, you do not want to invest in the newest hyped company on the stock market. You want slow and steady value creation to properly build wealth safely. If you think you can get rich quick, you could end up losing everything even quicker. By simply investing in index funds and ETFs, you will build wealth over time. To increase the speed at which you build wealth through ETFs and mutual fund investing, simply invest more money on a bi-weekly basis. Also, try to stay away from sales personnel or advisors who might advocate investments beyond your grasp. While their intentions could be decent, their motivations can be rooted in commissions that may put your portfolio in danger. Instead, research strong-performing index funds, mutual funds, and ETFs. Even seemingly straightforward investments like bonds can be a mistake depending on your age. If you are investing in strong companies or funds, bonds should only be an afterthought. Bonds are good for keeping someone wealthy, but they are not very good at building wealth itself. Step number 5. Embrace a prolonged investment strategy. By having a buy and never sell mentality, it allows you to not panic sell, which could be catastrophic for your portfolio. This also means that you should only put well-established companies in your retirement accounts. Emotional impulses can precipitate ill-advised actions. For instance, a surging stock might entice an unwary investor to allocate money to it, but ultimately, this could be a mistake. For every time it works, there are 2 times when the emotional investing style fails. It is better to continually invest in strong ETFs than to constantly buy the newest surging stock. Conversely, during market downturns, despite what your emotions are telling you, this would be the best time to buy stable and steady index funds, mutual funds, and ETFs such as QQQM and MTUM. Resolute evidence underscores the efficacy of retaining investments through even the most trying markets. This strategy prevents impulsive reactions to news or rapid price fluctuations. By simply being the market instead of trying to outsmart it, this will lead to superior dividends and profits over the long haul. Here are some extra strategies to ensure you retire as quickly as possible. To propel your retirement savings, consider the implementation of the following tactics. Tactic 1. Forge a budget. Meticulous money management will get you much closer to your retirement aspirations than if you do not have a budget. Every single dollar you bring in should have a name. This means that for every cent you earn, you should know where you are going to put it. You can use the free version of the budget app named Every Dollar to get started. Tactic 2. Automate savings. Effortlessly cultivating savings is achievable through the establishment of automated deductions from your checking account to a designated savings repository. You can set up a time every 2 weeks when your bank will automatically move money from your checking account to your savings account. Although savings accounts serve as accessible reservoirs for emergent cash needs, once the amount of money in your savings account surpasses what you would need to pay for 3 months' worth of expenses, put every dollar after that point either toward paying debt off or put it towards investing. Tactic 3. Leverage employer contributions. Exploit the full potential of your workplace retirement program by ensuring contributions sufficient to trigger the complete employer match if one is offered. Overlooking this means you are leaving free money on the table. If your employer offers a 401k or other savings account, at least invest a percentage up to the employer's matching contribution. If they do not have a match, focus on maxing out your IRA. If you do not have an IRA, then make one. And lastly, Tactic 4. Curtail superfluous outlays. Negotiate to reduce your car insurance premiums or stop eating out, and instead prepare homemade meals, which are both ways to save loads of money over the long haul. By harmonizing sound financial principles with a strategy uniquely tailored to your needs, the panorama unfurls for an odyssey toward retirement that is secure and gratifying. These guidelines have garnered admiration for their broad applicability, although the crux of triumph lies in personalization. Regard them as bedrock principles and general rules of thumb. By following these steps and tactics, you will become successful with money. Feel free to leave comments with your questions and I will answer them. Also, remember to do your own research or meet with your HR department or financial advisor to go over options that are right for you. With that being said, make sure to press the like button and subscribe for more personal finance videos like this one. Stay tuned for more content, and I will see you in the next video.